former Reagan budget director David Stockman. And David, you wrote a book about this coming correction, the Great Deformation. Scott Shelley just said he thinks the rally goes on because more important than a little old guy coming in is the fact that central banks around the world continue to print. That's your premise. Oh,
they continue to print, but the question is, this is the fourth great bubble of this century. What happened to the last three? They ended in devastating carnage because central banks can print and print and print until finally there's some kind of triggering event, a black swan, things go too far, and the whole game unravels. Right now, Wall Street is gone. You know, the mania from the ridiculous to the just plain stupid.
But here's the thing, though, David.
And predictably, they're calling in the sheep for the slaughter, the retail guy to come in because the market's cheap. The market isn't cheap. The market is trading at 20 times trailing earnings based on the third quarter.
What about forward PE? The forward PE ratio is relatively low based on historical standards. But here's the thing I want to talk about.
But can we talk about, but Charles, let's talk about that.
You just said a lot of things. Let's address them. The economy is cyclical. The stock market is cyclical. Anyone can say eventually the market's going to crash, and at some point you'll be right. But at the end of the day, we seem to somehow come out of these crashes, if you will, these big giant bubbles you described. And when we rebound, we seem to rebound higher. So it doesn't argue to a certain degree that if you stay the course, you're going to be okay. Or if you wait it out, if you try to wait. The irrational exuberance speech was in 1996.
Right.
The rally continued for more than 3 more years. A lot of people missed it.
And then it crashed, and the retail investor lost $5 trillion. Then he waited and waited and waited. He got in 2007 at the top of the bubble. Then it crashed. Then he panicked.
The retail investor lost money because the
retail investor has been sold down the river 3 times this century by the Fed, in housing, in .com, and in the great stock market bubble of 2008.
By the Fed.
By the Fed, because the Fed is flooding the street.
What would the Fed do? In other words, I'm not a big Fed guy, but we have fiscal policy in this country that's decidedly anti-business. Now, when I hear Ben Bernanke speak, he sounds like a guy who might be begrudgingly, or just he's doing what he maybe doesn't even want to do. He may be going against his own internal intelligence. But what's the alternative when you have an administration that doesn't like capitalism, that's selling the country down the different path?
I'm sorry, that has nothing to do with it.
It has nothing to do with it.
No, Bush was. Let me answer. They're sitting on $2 trillion of cash. They're sitting on 13.
Why?
Wait a minute. They're sitting on 13 trillion of debt. They have borrowed $2 trillion since the crash. They have added to their balance sheet.
Yeah, but you're doing a zero-sum game.
No, I'm not doing a zero-sum game.
Listen, these guys aren't idiots on Wall Street. They know how to hedge their debt. But what you're saying is you don't like the Fed's foam on the runway, constant money printing and the constant borrowing. I get that. But you're underestimating how the market is pricing it, too. The market, as Charles points out, only 15, 17 times forward earnings. And the retail investors not back in a big way. They only came back in a sixth of what they took out since 2008 of the equity funds.
Okay, but let me respond to that. 15 to 17 times, that's on the hockey stick that the Pinocchios on Wall Street constantly project and never comes out. Look at the real earnings, GAAP earnings reported third quarter, $90, only up 3% from 2 years ago.